Advisors Asset Management offers a suite of innovative ETFs to help investors meet their income and capital appreciation goals. Visit aamlive.com/ETF for more information.
This is Exchange Traded Fridays, brought to you by ETF.com. I'm Sumit Roy, Senior Analyst here at ETF.com, and we have a very exciting episode for you all today. We're going to be talking about launches, flows, crypto, and of course, the presidential election and what that could mean for your ETFs. We also have a very special guest who is going to be joining the conversation, Aniket Ullal, the head of ETF Research and Analytics at CFRA. Aniket, thanks so much for being here.
Thank you for having me. Excited to talk to all of you.
Absolutely. Along with Aniket, several of my colleagues are on the pod as well. Wealth Management Editor Jeff Benjamin and Contributing Editor James Rubin. How you guys doing?
Glad to be here. Looking forward to the conversation.
Same here. And I want to kick things off by talking about launches, big topic in the ETF world this year. Aniket, you wrote a very interesting article which we published on ETF.com in which you discussed the most successful ETF launches of the past decade. I definitely want to talk about that article, but first, I think it'd be great if we could touch on the most recent launches, the ones we've seen come to market in 2024. We're on track for a record year in terms of the number of new launches this year. And, every year we seem to have categories or themes that seem to be prevalent among the new ETFs that are launching. One trend that I'm seeing is the proliferation of leveraged single stock ETFs, options-based ETFs, and these derivative ETFs in general. I know there's a lot of different flavors of these derivative ETFs. Some are riskier than others, but what's your take on these, Aniket? It seems like they're very popular, especially among retail investors.
Well, they're certainly popular. I think it depends on the underlying security that's being tracked. What we've seen is that if you have stocks that tend to be more volatile or where there tends to be more uncertainty around earnings, or where the stock is kind of, doing well, had a run up due to various trends, including AI and so on, those products tend to be much more popular. We saw, when the Tesla products were launched, those were very successful. More recently, within the NVIDIA leverage products have done well. So, yeah, we've seen the ones around consumer discretionary, consumer staples, probably not as much. So, obviously, volatility in the underlying security and then success of the ETFs tend to be related. Just more broadly, through our research, we've noticed that assets tend to pool around the most highly leveraged products. If you look at all leveraged products in the market, most assets and volumes tend to be pool around the 3x products. Of course, we don't have 3x for single stock, but they tend to pool around the more leveraged products. And so clearly, investors like that, like the ability to double down on a particular trade.
This is a thread that you cover in your report to a large degree, or it's one of the main takeaways, namely this ability to sort of react quickly to market conditions. Isn't that the case?
Absolutely. The thing with ETFs is there's such a wide range, right? We've got the traditional kind of broad headline index tracking ETFs. It's important to remember that these are still the funds that take in the most assets, despite the fact that they're not the ones that see the most launches. An interesting stat is if you look at just September, right? All the flows in September, there were $97 billion went into US ETFs in the month of September. Of that 97 billion, 62 billion went into ETFs that were launched more than a decade ago. In fact, if you look at the top 20, 62 billion went into the top 20. And of those top 20, 17 were launched more than 10 years ago. Only 3 were recent launches. And when I say recent, I mean last 10 years. That's not even that recent. And so it's important to remember that even though there's a lot of attention to the new launches, a lot of the majority of the flows are still going into very traditional ETFs, which have been launched for a long time. Yeah.
Yeah. Are you struck by the speed of reaction? That seems to have really picked up, hasn't it, over the last year, 18 months?
That's a great point. I think there are a lot of things that have changed in the ETF industry from where we were 15 years ago, right? The most important being the ETF rule, where issuers didn't have to get exemptive relief on every single filing. I think that was a huge change in the industry, where issuers could bring things to market much faster. I think also issuers have much more experience now with launching products. The SEC is also more comfortable with different types of structures. So there's a lot of structural changes in the industry that make it much easier to bring products to market than, let's say, 10 years ago. So I think it's absolutely true that issuers are much more on top of what's happening in the market and trying to react faster. And also they see that there's more opportunity, that if there's a white space, a first mover advantage can be important. And I think that's the other reason they're reacting faster.
And it seems like, Aniket, issuers are willing to just launch a bunch of products and see what works. Ultimately, most of the ETFs aren't going to gain traction, right? I think you talked about how there were something like 3,200 launches over the past 10 years, but only 38% were considered to be viable, and only 10% had peak assets exceeding $1 billion. Do you think that's going to continue to be the case? Only a very small percentage of ETF launches are ultimately going to lead to a successful ETF?
I think that's only going to increase. I mean, if what we did essentially is we took all the launches within a 10-year period, excuse me, and we broke it up. We broke the outcomes into different buckets. So we said, okay, which ETFs are delisted, which ones are subscale. In other words, they never crossed 100 million during their lifespan. Which ones were viable, between 100 million and a billion, which ones were established, above a billion, and so on. So we broke it out into different buckets. And what we found is that only 38% of all the ETFs launched stayed listed and crossed 100 million. In other words, what we would consider to be somewhat viable. Now that's, depending on your perspective, I don't know if that's good or bad. I know Jeff used to work in the sports industry. If you're in baseball and you're hitting 300, that's probably a pretty good rate. So, but I mean, so it's pretty hard to get scale, and only 10% of all the launches actually crossed $1 billion. So essentially, what that means is it's getting more competitive. It's still a very much a winner take most kind of business, and so I think issuers know that if there's a space that's opening up, they need to get into it early and win in that category.
Has the number decreased progressively over that 10-year period? Did your data show anything about that?
Yeah, so it depends on the category. So it's interesting. What we found is that in the index space, the rate is kind of stabilized. So what we did is we looked at the first 5 years, and then we looked at the entire 10 years. If you look at index products, it's generally stable at around 37-38%. In the active space, it's actually if you look at just the first 5 years, 50% of the funds were viable. Now, is that because active funds are still launching, that it's a relatively newer space? It's possible. So it's possible that over time we may see active launches also slowly kind of revert to the mean and get closer to the 38%. But at the moment, we're seeing active have a higher success rate than indexed. But again, that the jury's out on whether that will stay higher or not over time.
I'd like to ask you a little bit about what you think about the direction of these single stock ETFs, where they could go, how this could push to another level or another category, because clearly these are designed for traders. These are not long-term investors. Actually, you're not even supposed to be investing long-term for these things. In these things, I kind of look at them as like disposable. They're out there. They're designed to basically tap into something that shows potential for a lot of volatility, so you can go long or inverse. And when that light dims, I would imagine these things just kind of fade away, and there'll be another shiny object of single stock or single security ETFs. I mean, it's probably always going to be, the growth, the technology area. You need volatility to make these things work. But I'm just wondering, Aniket, if you've thought of anything that, where the next step is in the kind of the single stock ETF development.
Yeah, well, to some extent, I think there's a tension between two things. One is giving retail investors who trade often, like day traders or professional investors, more tools who have high conviction to trade more often, and the other balancing that versus against investor protection. In other words, in making sure investors don't take too much risk and understand how these products work. And I think the SEC is kind of tried to thread the needle on that. I think that's the reason why they haven't allowed 3x, for example, single stock leverage products, right? I think at some point there's going to be a natural limit, right? There's only a certain number of stocks which are going to be highly volatile, which are followed by a lot of people, the Teslas, the Nvidias. So I think we eventually will see some slowdown, but there's always going to be appetite for these kind of products, and I think that ultimately the SEC has to decide what level of how comfortable they are allowing a lot of leverage products. And I think they have to. So far, I feel like they found a decent kind of medium of being able to find a balance, but I think maintaining that is going to be important.
Do you see the multiples increasing though at some point?
They've been increasing on the broader headline indices. On the single stocks, I think the SEC has been a little bit more restrictive, but yeah, it could certainly, the pressure on them to increase it could go up. But I think they have an interest to also make sure that investors don't take too much risk, which is why I think, like I said, they need to balance both of these two things.
Just one other question on this sort of nimbleness from the issuers, and a point you also make in the report is about, and I paraphrase here, trends changing very quickly, and you reference that in terms of ESG funds, which were the sort of flavor du jour, and now are much less so. So, do you see these sort of the winds blowing one direction and then another direction very quickly going forward?
What we found is that for new products to be successful, they need to meet 3 or 4 different criteria. When I say successful, I mean become really big, right? Like potentially get close to the $5-10 billion range or above. One is the category needs to offer some unique type of exposure, right? Second is investors need to value that exposure. In other words, it needs to match the current investing environment, and the issuer needs to win in that category. Now, if you look at certain ETFs, they've done all 3 of those things. If you look at JEPI, for example, which is a JP Morgan, covered call strategy, right? They essentially kind of pioneered call writing as a way of generating income, right? The timing was good because it was launched around the 2022 downturn when people were looking for more security, and they have distribution muscle, right? So they were able to meet all of those 3 criteria. It's the same with IBIT, the iShares Bitcoin product, where investors were looking for that exposure. It was unique, and iShares was able to win in that category against 10 other competitors. So it takes quite a lot to win in a category. But to your point, the winds can shift. I mean, the best example of this, actually, I didn't cite in my research because this fund was launched prior to the 10-year window, is actually DXJ, which is the Japan currency hedge ETF. If you go back and look at that ETF, it used to have $18 billion in assets, right? This was when there was a significant depreciation in the yen from about 2012 to 2015, which drove demand. Now that fund, I think, is down to about $3-4 billion. So sometimes if the macro environment moves against a particular fund, and I think this is particularly true in areas of active investing or thematics or something like currency hedged, which is susceptible to currency movements, then I think there can be situations where assets can change, or flows can move against the fund if the investing environment is not supportive.
Speaking of flows, Aniket, this has been an extremely strong year for inflows when it comes to US listed ETFs. I think we're up to $775 billion of year-to-date inflows, which, if my math is correct, puts us on track to eclipse $1 trillion in inflows for 2024 as a whole. We're also seeing records for individual ETFs like the Vanguard S&P 500 ETF, VOO. It's $78 billion of inflows, are the most for any ETF ever in a calendar year. And, of course, there's been crazy high demand for Bitcoin ETFs and things like that. Aniket, I've asked Jeff and some of the other ETF.com team members whether ETFs are going to top $1 trillion of inflows. Most of us seem to think it will. I want to ask you the same question, but also a bonus question. Do you think VOO can top $100 billion of inflows this year?
On the aggregate assets, I would say it seems likely because we generally tend to see a pretty big bump up in assets in December, particularly in SPY. If you look historically at SPY, we typically tend to see big inflows into SPY towards the end of the year, maybe for various reasons, including taxes and hedge funds equitizing cash and so on. So I think we have a pretty good chance that it certainly looks like it will be a record year, both in terms of flows and launches. On VOO specifically, I haven't looked too closely at that. I'm not sure, so I'll defer to you guys on. But certainly Vanguard has been a vacuum cleaner in terms of taking in inflows, so I wouldn't bet against them.
Absolutely would not bet against them. And VOO is obviously the number one ETF when it comes to inflows this year, but you touched on IBIT and a lot of the other Bitcoin ETFs seeing huge amount of inflows. I know, James, you wanted to talk a little bit about crypto ETFs in general, what we're seeing there in terms of flows, as well as, new launches in that category, right?
Yeah, let's look at the very recent past. I mean, we're seeing a real surge the last 4 days. We had 450 million in inflows yesterday, 371 the day before, 550 million on Monday. It's over or roughly, what is that, 1.6 billion over the last 4 trading days. First of all, what's driving the surge, in your opinion, just the last few days, aside from Bitcoin's price going up? What's behind that? And then more widely, I'd be curious what your thoughts are on sort of the future for these crypto funds.
Yeah, I mean, firstly, if you look at in the bigger picture, if you look at all crypto ETF assets right now, I think we're at about 75 billion. That's actually about half the amount in gold ETFs. I mean, gold is one of the oldest asset classes around. So, I mean, just to put this in context, this is a very fast-growing, successful category, which is rare in the ETF space to see something like this grow so fast. In fact, IBIT is the fastest, most successful launch in history. It only took 7 days to reach $1 billion in assets. In terms of what's driving demand, I think it's really been 2 phases. The first phase, which was the January to March phase, in our opinion, was much more of a retail driven. By retail, I'm including both self-directed and wealth RIA-driven demand. We looked at a lot of the 13F filings. It was in our estimate, institutional holding was probably less than 20% of the holdings. Most of it was actually retail, and the institutional was probably a little bit more hedge fund heavy. What we may be seeing in the second wave is more, now that these products are established, more institutional investors coming in. These could be, larger asset managers, pension funds. Also, the ETF issuers slowly breaking into some of the wirehouses, which have a fairly rigorous process of evaluation. So that second phase of institutional adoption is much more of a kind of, you got to grind and go through the sales process and convince all these institutions to buy. That's probably what we're seeing right now. I can't confirm that for sure, because until we see all the data on 13F filings on the holders, we don't know for sure. But that would be our hypothesis, that it's now migrating from much more of a retail driven demand to more institutional demand. And also it's gone beyond just the grayscale rotation, right? A lot of the initial demand is also driven by people who are rotating out of GBTC and into the other products for cost reasons.
Do you have any sense of what those volumes are? Is that part of your research at all?
Yeah, I mean, when we've looked historically, we've seen that the demand for that has gone into the spot products has significantly exceeded the rotation out of GBTC. So in other words, it's very clear that there's demand that goes beyond just GBTC rotation. And so, like I said, initially the demand is probably more retail, and now it's probably more institutions coming in.
Good. Could I pose this next question to the panel in general? Is everybody, or the folks that you all are speaking with, Jeff, wealth managers, DJ, you're reporting, Sumit, are folks in general surprised by just how fast this category has grown?
Honestly, I think there was a lot of hype leading up to the spot Bitcoin ETF launches, right? This is a saga that was, I think, 10 years plus in the making. So I think a lot of people anticipated a ton of pent-up demand, but maybe the numbers are, a little bit better than even people imagined. But I don't think it really, came out of the blue or anything like that. A lot of people did expect Bitcoin ETF demand to be really high. Bitcoin was obviously already a $1 trillion plus market cap asset. So it has, I think, met the very lofty expectations that people had for the category, but I wouldn't say it's necessarily a surprise. On the other hand, I think Ether ETF inflows have been a little bit disappointing, right? A fraction of what we've seen for spot Bitcoin ETF flows. And obviously, Ether itself is kind of struggling. And there's all sorts of questions about the technology roadmap for that platform. So I don't know. It's really strong demand for Bitcoin, not a strong demand for Ether ETFs. So we'll see what happens going forward. But, all signs are very positive for Bitcoin ETFs as a category right now.
Jeff, you've written about there being sort of mixed reaction in the advisor field. Does that persist, or do you see sort of greater receptivity in that profession?
I think among financial advisors, Bitcoin, whether it's through an ETF or other access points, is very much a niche. I think most financial advisors, especially the older ones, are still seeing this as a untested fringe market. I think you've got some financial advisors that are just all in, dyed in the wool, Bitcoin, crypto, but I don't see a lot of people that are on the fence. I mean, you either are in or you're not, and some advisors will tell me that they, if their clients are interested, they'll buy them a little Bitcoin ETF, or they'll set aside some money for them to do that on their own. But it's not like people are treating it as another asset class that has to be a wedge in the overall portfolio. I think something that might change a little bit of that, and something that I kind of anticipated, was a big rally in the price of Bitcoin. And we just haven't seen that. So, I mean, there's been fits and starts, but, hovering around 65 or whatever it is right now is probably not going to move the needle for a lot of these people that still think it's just a digital thing out there.
Yeah, although the blockchain betting platform that everybody's paying a lot of attention to for the presidential election, Polymarket, is predicting that we'll see Bitcoin top 70,000 sometime this month, which I think would be the first time since March. But that's still short of the all-time high of 73,000.
That's true, but I think it's also important to note that a lot of the possibility of this product getting approved was telegraphed in advance. And actually, if you look at the price of Bitcoin from about October of 2023 to January, and then even after the launch till about March, there was actually a very significant run up in the price.
Yeah.
So I think a lot of the price run up got baked into the pre-launch time frame, and then the 2 months post-launch. I agree with you. Since then, it's moved a lot sideways, but I would say there's actually been significant appreciation between about October of last year till about March of this year.
Yeah, I think there are a lot of people waiting for it to make its big jump. Beginning of the year, you had multiple analysts predicting they'd hit six figures at some point this year.
And James, you talked about how the price is kind of in a holding pattern. A lot of
Yeah,
people have been talking about how, maybe the presidential election that
yeah.
could potentially drive Bitcoin this way or that way. Obviously, a lot of people think that Trump becoming president would be bullish for Bitcoin. So I think that's a good segue into our next segment, which is, the impact of the presidential election on ETFs. Jeff, what do you think? Do you really believe that, Trump winning is going to drive, Bitcoin prices higher?
Well, on the Bitcoin specific topic with the election, this was something that was pretty well reported a few months ago that uh, the Democrats seem to be kind of stiff arming Bitcoin a little bit, and so Trump jumped all over it and said, if I'm elected, there's going to be a Bitcoin in every pot or whatever, and then I think the Democrats kind of got on there too, and a lot of people say that's what forced through the Ethereum ETFs because there was pressure on the SEC from the Democrats. I mean, that's just to me, that's just pandering from politicians, which is, from my perspective, all they really do when they're trying to get elected. Some do follow up on some of the things they promise, but mostly there's a lot of promises, as we all know, or anybody that's watched any television over the past few weeks or opened their mailbox. I don't know. I'm getting metric tons of these cards saying vote for this person. But what's kind of interesting, and I did write a story about that this week, the markets and elections. And we even had our advisor views series. We had Adam Reinert of Marshall Financial. He did a Q&A on presidential elections and the impact. And it really is interesting. I mean, I don't know. Maybe it would be worth doing a historical look at. Well, actually, Adam did do a little bit of a historical look, but it seems like there's so much noise now. It seems like elections are so 24/7, 365 days a year now. I don't even remember when this election started. It just seemed like the last one ended. We got a president, and now they started running for president again. But some of the things that Adam, kind of put out there, which I thought was kind of interesting, and it sort of suggests that even though we look at this and we look at the markets and we think how sensitive they are to certain things, it really seems like they generally shrug off presidential elections, or they are now anyway. I mean, I remember when Trump was elected in 2016, there was a lot of people saying, "Oh my gosh, this is so crazy. Nobody expected this, and the markets are going to just get." And 2017 was a really good year for the markets. 22%, I think they gained that year, but it was the opposite of a crash anyway. And what Adam kind of, I'm going to paraphrase him a little bit here, but he said that going into the Biden-Trump election in 2020, where Trump seemed to be very pro-energy compared to Biden, and the campaign slogan was, one of the slogans was "Drill, baby, drill." Yet Trump's inauguration, this is from Trump's inauguration in 2017 to Biden's inauguration in 2021, the S&P energy sector declined by 32%. Now, you would think a president campaigning on "Drill, baby, drill" would have done something for energy, but apparently he, at least his influence wasn't there. And then conversely, so far during the Biden administration, the same sector, the S&P 1500 energy sector, has advanced more than 147%. So, I mean,
Yeah.
it's a long way of saying basically that it seems like the financial markets are the one area of maybe the entire world where you can, they say to hell with the political noise, you know?
Yeah, yeah, and exactly. And there's so many factors that go into pricing stocks and things like that. You mentioned oil doing well under Biden, poorly under Trump, and you look at the alternative energy ETFs like TAN doing very poorly recently under Biden, even though he passed, Inflation Reduction Act, which provides billions of dollars of funding for clean energy. So there's so many factors that the presidential policies and who's president has just a small part to do with it. especially over the long term. So, but I do want to get your thoughts, Aniket. Do you think, the election and the results of the election can have impacts on ETFs and, maybe ETF regulation or something we're not thinking about?
Yeah, I mean, I actually tried to look at this a little bit and see, is there a Trump-Harris trade? I think there's two problems with this. One is, as Jeff and you said very rightly, it's not always a direct line between policy and the outcomes, right? You may have a government that's pro particular sector, but the actual sector doesn't do well. That's one issue. The second thing, which I think Jeff alluded to also, is that if you look at the positions of the two parties, they've actually kind of converged on several issues. I mean, for example, Trump has talked a lot about China and China tariffs. But actually, if you look at Biden's policies, they've also been pretty hawkish on trade and particularly towards China. So there's been some kind of a little bit of convergence there. If you look at crypto, in theory, Trump is much more pro crypto, but the Democrats have really moderated their position now so that they don't lose out politically, right? And so there's been some kind of convergence a little bit on both sides, and so that makes it harder to parse out which party is going to be pro particular sector. I think the differences have gone down a little bit. In some ways, both parties have become more populist. I think two areas you can look at. I'd say the one thing that's probably most defining is regulation. I think that's one area where there's probably a fairly disparate approach. I think the Republicans tend to be much more, particularly in the financial sector, tend to be much more in favor of lesser regulation. And whereas Democrats tend to be, for example, if you look at Consumer Protection Board and issues like that, Democrats are probably going to strengthen that, whereas Republicans may weaken it. And if you look at the debates, one of the things I did was look at the two debates. One was the Trump-Biden debate and then the Trump-Harris debate. And I looked at how these various sectors moved on those 2 days after the debates happened. And one area where we did see significant movement was actually in the area of like mortgage lending and capital market ETFs, where, when Trump, you could argue that Trump probably won the first debate and Harris probably did better in the second debate. And when Trump won, anything related to financial regulation did much better, right? The smaller mortgage companies did much better the next day, whereas it was the other way around when Harris did better in the debate. So there are certain areas where there are differences, but other areas, like you said, like clean energy and trade, where views are kind of converging. So long answer, but hopefully to provide some context to the way we've been thinking about it.
No, absolutely. That's some great insight, Aniket. And I think that's a good place to wrap up the podcast. It's been an absolute pleasure having you on the show, Aniket. Thanks so much for your time.
Yeah, thanks for having me.
And thanks to all our listeners for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on Twitter at ETFcom. ETFcom. Catch you next week.